Let's look at the next structural shift, and that is the advanced drilling technologies that are impacting the energy market. Horizontal drilling and hydraulic fracking has truly become a game-changing event for this industry. It's really hard to overstate just how significant this has been. It's resulting in American energy renaissance, not only changing North American energy markets, but also impacting world energy markets. In this map, we're showing the shale reserves of the lower 48. Much of these reserves were previously uneconomical just a decade ago. It's not that the reserves weren't there, mind you. They've always been there. But we didn't have the technology available at the time to economically extract these oil and gas reserves out of the ground. But thanks to these advanced drilling technologies, we can, and it is opening up this huge reserve base in the United States. With the adoption of these advanced drilling technologies, the industry has seen tremendous increase in productivity. In this graph, we show the total U.S. production of oil and gas since 1973 to present. In 1973, we produced 19.5 million barrels a day of oil and gas. And since that time, we were in steep decline through 2006, where we bottomed at 13.5 million barrels a day. And in the last 7 years, with this productivity gains, we are now back up to 19 million barrels. Actually, I was reading last night, we are now 21 million barrels a day, so we've now surpassed the 1973 levels. This is all thanks to the advanced drilling technologies, and it is changing the world quite significantly. So not only are we producing more, but we're also importing less, and this is changing the structure of the world energy markets. Here we're looking at the reversal of net imports of oil and gas for the United States. After having peaked in 2006 at 14 million barrels, our net imports are now down nearly 50% at just less than 8 million barrels a day. Now, many of you may remember the 2006-2007 timeframe where the talk is we're at peak oil and we're going to run out. Well, there was a story at the time of a Saudi prince who was commenting about peak oil and the impact that was having on his family's favorite mode of transportation. In this article, he was talking about oil, but one of the things that stuck out to me is his comments about that. He said his grandfather rode a camel, his dad drove a car, and I have a plane. My grandson will be back on a camel again. Well, I'm not sure whether he really believed that or not, or if he was talking his book. You know, he sat on a lot of oil, so, feeding the frenzy at the time and pushing the price of oil up, served him pretty well. So maybe he was just looking to upgrade his plane. But what we all know is his grandson is not going to be back on a camel and riding that to work anytime soon. But the conversation now has changed 180 degrees. We're now talking about being a net exporter of energy. In fact, we're now exporting natural gas, whereas before we were opening up LNG import plants. We have 100 years' worth of natural gas in this country, where just a couple years ago, we were thought to be running out. It's amazing what technology can do to solve issues. And this is certainly changing the world energy markets. The huge increase in natural gas production is also leading to lower prices of natural gas. And we can see that in this graph. Here, we compare the price of natural gas around the world in many countries. The bright blue line is the price of gas in the United States, amongst the lowest around the world, with the exception of the Middle East, whereas most other countries are selling at $8 to $14. Our natural gas is priced at $4. As a result of the advanced drilling, and the benefits that the U.S. has seen, many countries are now desperately trying to match the success we've had in the U.S. Because of advanced drilling, but they're coming up short for several reasons. First, countries like Japan and Korea, well, they have no shale, so that's a no-starter for them. In Europe, property laws are such that the owners of property don't own the mineral rights, so there's no way they're going to let people drill on their land if they get no benefit. So it's not going to happen in Europe. China does have shale, but it's very difficult. They have a lot of clay in their shale, so it makes a gooey mess when you try to extract it. On top of all All of them lack the equipment, expertise, the know-how, and the infrastructure. So even if they try, it's going to take them many years to acquire these assets and be able to exploit the drilling technologies and increase their natural gas production, which is creating a significant and long-lasting advantage for the United States, and it's going to benefit those in the United States that use natural gas. So now let's look at who benefits. Certainly the U.S. consumer is going to benefit because of lower utility bills, but so do many manufacturers. And this is, by the way, is one of the key factors in the American manufacturing renaissance, because many manufacturers use natural gas as input or costs. In particular, fertilizer companies, pulp and paper companies, steel mills, tire and rubber plants, liquefied natural gas export business will benefit, and so will pipelines. But today we're going to concentrate on the chemical industry, because the chemical industry has the distinct role of being the largest industrial gas consumer in the country. So by looking at the chemical industry, we know that ethylene is king in the chemical world. By volume, ethylene is the most widely used petrochemical throughout the world and serves as a key building block in the production of other value-added chemicals, such as PVC, vinyl chloride, ethylene glycol, styrene, polystyrene, and that then is used to make a variety of consumer goods like adhesives, tires, shoes, bottles, windows, flooring, you name it. Ethylene itself is produced in a process called cracking, which is done either by using naphtha, which is an oil-based derivative, or ethane, which comes from natural gas. Now here's what gets really exciting. In the United States, 70% of our ethylene production is done from natural gas, or ethane, where in the rest of the world that's reversed, where most of them use a naphtha-based or oil derivative. So the low-cost gas in the United States is creating a significant competitive advantage for the domestic ethylene producers. By looking at the global cost curve among major nations, here we're going to look at 2005. This, if you recall from the previous chart, this is when natural gas was at high levels in the United States. Notice on the far right, the United States is at the highest ethylene cost among the major nations, making ethylene and, by extension, the U.S. chemical industry uncompetitive relative to its international counterparts. This also explains why many companies were offshoring production, because they wanted to get closer to their raw materials providers. It also explains why we shut down many plants over the last decade. As a result of the energy renaissance, we're seeing a major shift in the ethylene cost curve. Today, here is 2012's cost curve, where you can see the United States is very significantly advantaged relative to all but the Middle East. Notice China, Europe, and Northeast Asia all have ethylene costs of 80 cents a pound or higher. And that compares to the United States ethylene cost of roughly 30 cents. So at less than half the cost of China and Europe, and only slightly more than the Middle East, this is driving a significant structural shift within the ethylene business, which is producing positive implications for not only the producers, but also the consumers of domestic chemicals. As a result of the domestic chemical producers, they're gaining share, and they find themselves needing to add capacity. On the opposite side, the foreign companies, the foreign chemical companies, are losing share, and they'll remain uncompetitive unless they shift production to the United States, and we'll likely see some plant closures in Europe. So in order to meet all this future demand, the domestic chemical industry is now embarking on the largest spending period we've seen in the last 20 years. We've been tracking the pace of this chemical build-out ever since we identified this theme more than 2 years ago. And each year, the estimates for the chemical build-out has increased. Based on data from the Industrial Info Resources, that's a third-party company that tracks this, there's currently $73 billion that's going to be spent over the next 5 years, and that number is going to approach $100 billion in the next 7 years. This spending wave is creating a great opportunity for us to invest in companies that will benefit from this spending that's occurring in the industry. As Arnold mentioned, we like to invest in the picks and shovels. Well, in this, it's the parts and pieces that go into chemical industry. Here we take a look at an overall chemical plant and where that $70 to $100 billion is going to be spent. 9% is in the engineering services, 43% is spent in the equipment, and 48% is spent in the construction materials and the labor. Breaking it down further, that 9% in the engineering services will result in an additional $6 to $9 billion of revenues over the next several years just due to the chemical build-out. Now, these companies also will benefit from the paper mills, the rubber mills, the steel plants, but just to the chemical industry, it's $6 to $9 billion of additional spending. Companies that we have that will benefit from that are Jacobs Engineering and CDI. We bought them both several years ago. 42% of the pie is represented by the equipment companies. And this group is expected to see an additional $30 to $43 billion in incremental spend. Here we own Powell Industries, Encore Wire, and a group that we've labeled top secret. While we're trying to buy these stocks, or we're close to buying these stocks, but just in case anybody in here wants to get a little jump on the action, we'll hold off to revealing the names until we've bought them. The next 48% is the labor companies, the construction material and labor companies. We see $33 to $48 billion in incremental spending. Portfolio holdings here are again CDI and Jacobs Engineering. They're involved in the construction as well, but also Insteel and Orion Marine. Additional companies in the portfolio that will benefit are Granite, Emerson, and Aztec. Now, by looking at this chemical build-out geographically, we see that while the chemical projects are planned throughout the United States, the majority of them will be built in the manufacturing centers of the Gulf Coast, the Midwest, and the East Coast. This also happens to correlate nicely with the population density of the United States and will add jobs, increase incomes, provide support for additional businesses, and it's close to local manufacturing consumers, so it's going to lower the cost of freight, which will improve the competitiveness of U.S. manufacturers. All this will add positively to these local communities in these regions, which provides the next step in our next phase in this theme, which we are in the middle of exploring, and we'll keep you posted as that progresses.